Matthew Bell with insuranceprescription.com, and today I have a somewhat arcane subject to get into. It is a bit difficult, but I think it's important. So it is the difference between an average rate of return, an arithmetic average calculation of a rate of return, and a compound annual growth rate calculation for the same rate of return. I want to try and state this as simply as I can. This video is about the practical difference of the arithmetic average rate of return and the compound average or the compound annual growth rate. And the basic way of stating this, I guess, is the S&P averages 10% per year. It goes up and down year after year, hardly ever hits 10% right on the money, but it averages 10%. And an arithmetic average, very simply, is where you take over a period of time. So let's say over 10 years, you would add up all of the annual returns and divide by 10. So if you're doing the average over 20 years, you'd add up a 20-year period's worth of S&P rates of return, and they'd be all over the place. And then you divide those by 20, you divide them by 30 to get a 30-year average, and so on. And when you do that, you'll find, and you can just Google this, or you can look for the rates of return yourself and perform this calculation as I did, and you'll kind of see it in a moment. Or you can simply look up what is the S&P average rate of return, and you'll get something in the neighborhood of 10%. 9.85, I think, was the rate of return after 2015. I'm not sure what it is now. As of 2013, the annual rate at 30 years was like 11%. So, but those are average rates of return. And what I want to talk about today is how, when some commentators, even though they'll say that it's an average rate of return, they will then proceed to use a compound interest calculator to show you what you can expect to get if you had your money invested and got that average annual rate of return, what you could expect to obtain, what your portfolio would look like after 10 years, 20 years, 30 years, or whatever your projected retirement age is. And so, to put this very simply, if you use a compound interest calculator to calculate your rate of return for something like an S&P average rate of return, you're almost certainly going to get the wrong number. It's going to be too big. It's going to estimate that you're going to end up with a value that is higher, sometimes a lot higher, than what your actual investment experience will bear out. A couple of things that I want to say. First of all, the difference between the average, the arithmetic average annual rate of return, and the compound annual growth rate diverges more and more depending on how volatile the instrument is. So if you take a fixed instrument with a fixed rate of interest, the average rate and the compound annual growth rate will be the exact same number. And so it is theoretically possible for the two of them to coincide with the market as well. But because the market is volatile and moves up and down, those numbers diverge, and the more volatile they are, the more they're going to diverge. Now, I can give you a very quick and dirty example of how volatility affects this divergence. So this is a very quick example, but it'll illustrate the difference between annual rate of return and compound rate of return, and it does it fairly well. So even though it's an example that is not realistic. So the example has us imagine that we start off with a $100,000 investment, and the first year we get a 100% rate of return on our money. So that means on $100,000 you make $100,000 and you end up with $200,000. Now the next year you'll lose 50% of your investment, so you get a negative 50% return. Now, to calculate the arithmetic average, you simply take the first year's return and add it to the second. So the first year's return was a positive 100%, second year's was a negative 50, so 100 minus 50 gives you 50%, and then you divide by the number of years, which is 2. So 50 divided by 2 is 25. So the annual, the arithmetic average for your rate of return in that situation is 25%. However, when you consider that you started with 100,000, you doubled it, then you lost half of it and ended up at the exact same place that you began with, it's kind of interesting that this annual average would be 25% because you ended up at the exact same place that you started off. If you do the compound annual growth rate calculation on those numbers, you'll find that your average is 0, which actually comports with your investment experience. Again, I'm not saying that's a realistic example. I'm simply saying that this is one way of illustrating how wide the divergence can be. It can be very narrow, again in the case of a fixed instrument, or it can be very wide. So now there are two things about this. The first is that even if you do get a 10% return on average on your money, and you get the exact same performance, let's say, as the S&P or some other index, you can expect that your returns are going to be less than the figure that you obtain if you were to go to a compound interest calculator and punch in 10% over 10 years or 20 years or whatever. So if you're accustomed to using a compound interest calculator, you have to realize that the number you're looking at there is not, almost certainly not, going to be a representation, a true representation of what you can expect to gain in a particular account using an average rate of return in the position of a compound interest rate. Now the second point is that most investors are going to fall far below the average. And now this is going to be the subject of another video for the most part, but I will touch on it at the end of this video. And so when you put those two things together, I think what it points to is you have to have realistic expectations. And Dalbar, the independent organization that rates and ranks different vehicles and consumer performance in the market and other things, advises that you need to make sure you think that you are going to get less of a return than the actual market index. And I think most people don't have that expectation. I'm not a financial advisor. I'm not an economist. I do not hold an MBA. I don't have any special expertise in this. It's simply me trying to get a handle on various things, pieces of information and things that I have run across. It's important to me to try and get a grasp on some of these concepts. Now let me just explain why I think that this is an interesting topic and why I think it is worth discussing it. And here's the first reason that I'm going to give. If you just Google the question, why is it important to start investing early? This is one of the results, and obviously Google results are constantly reshuffling and different pages are vying for position, but as of this particular writing, this is one of the top results that comes up, and it's an Investopedia page. The article title is 5 Advantages of Investing in Your 20s, and down a little ways under the section on time, it talks about the advantages of compounding. So with simple interest, obviously, whatever you invest, your principal, is operated on by a particular rate of return or rate of interest. In a simple interest scenario, the interest that's generated year after year is the same, and it's simply a function of the interest rate and the principal. With compound interest, the interest rate works not just on the principal, but also on the interest that you've generated in previous years. So there's a compounding effect. Now, that is indisputable. So there's no question that when you have your money invested in the stock market in a tax-deferred vehicle, in any case, you're going to get this compounding effect. That's for sure. But the quibble that I have is, time and again, the way in which this works is illustrated with a compound interest calculator. So first, let me just establish, at least to some degree, that this is in fact the case. So again, looking at the Investopedia article, under time, we see a single investment, and I'm looking here at this paragraph, a single investment of $10,000 at age 20 would grow to over $70,000 by the time the investor was 60 years old, based on a 5% interest rate. So if I go over to MoneyChimp and I put in, this is a compound interest calculator, if I put in $10,000 with no additional contributions over 40 years at a 5% rate of return, compounding one time annually, and I calculate, I get $70,399.89. So indeed, 10,000 grows into 70,000, assuming a 5% interest rate. And again, that's 5% every single year over 40 years. 5% the first year, 5% the second year, 5% the third year, and so on all the way up. Now, the comment that they make then is that same 10,000 invested at age 30 instead would yield only $43,000 by age 60. And now it's $43,219. And again, that's the case. And finally, at age 40, making a $10,000 investment would yield only $26,000. You end up with $26,532.98. But here's the point. This is, once again, it's assuming a 5% annual rate of return every single year. 5%. And let me just show that this isn't, I think, an isolated case. This was the top search that I got. It's from a website titled Veterans United. On the article on their website entitled 5 Reasons to Start Investing Early, under the section Compound Interest Really Makes a Difference, you see a similar example. In this case, we're told we're going to be contrasting here Madison and Cooper. So 25-year-old Madison invests $2,000 annually over 10 years in her company's 401k with an average growth of 10%. Now notice this, an average growth of 10%. When she retires at the age of 65, her investment would have grown to $556,000. In a 401k, yes, there is going to be an average rate of growth. And if her 401k performance exactly comports with, let's say, the S&P's average over the last 10, 20 or so years, then we could expect her to receive an annual average growth rate of 10%. But what happens is they proceed to give you a total that is calculated not on an average growth rate of 10%, but on an annual growth rate of 10%. Now I'll show you. We start off with 0. We're told that she adds $2,000 over 10 years. At 10%, she would have $35,000 at the end of her contribution period. So what I do is I take that $35,000 and I paste it into a new calculator. This time, she is not actually adding to the contribution, and in fact, we get the exact number at 29 years rather than 30. At 29 years out, at a 10% growth rate, indeed, her portfolio would end with $556,197, which is to the dollar the amount that they suggest. So these must be something close to the assumptions they're making. Now they ask you to contrast that with Cooper, who at the age of 34 invests $2,000 annually over 30 years. So he's putting in 3 times as much money, and they ask you to observe that he ends up with $328,988. So $2,000 over the course of 29 years, $326,988, which the 988 is exact, but the 328 is, I'm thinking it's probably a typographical error here. Let me explain the point that I agree with. Obviously, they're saying time is on your side. If you invest a smaller amount earlier, you can end up ahead of a person who has to invest more money later on. That point is perfectly sound. Additionally, the assumption of an average growth rate of 10% is arguable. I would hesitate to use it in projections myself, but it is arguably accurate because of where the S&P has been. And I'll just jump over to this article here by The Balance, and you'll notice it says for the 20 years ending on December 31st, 2015, the S&P averaged 9.85% per year. That is rounded to 10%. That's the average for 20 years ending in 2015. So is that a reasonable rate of return to assume? It is, but it is an average rate of return. And so the objection that I have is that the compound interest calculator is being used to show you the projections for where she will end up. And the compound interest calculator assumes, of course, that you are getting 10% steady, rock solid every single year for the entire duration those investments are invested. And what I'm going to then kind of dive into a little bit more is to show you that that is not actually the case. Now, this is not going to be news to people who are savvy, but I was not savvy when I started off. This was a revelation to me, and I know in conversation with people over the last 2 years, there are a number of people who also do not quite understand this point either. So here is what I'm going to start with. I'm going to start with the sentence that's highlighted there. For the 20 years ending on 12/31 of 2015, the S&P averaged 9.85% per year. To get the average, I just Googled S&P average return. We're on a website called Slick Charts. This particular website, basically you can see, represents the S&P's returns over a period of time. And if we look at it in 2015, you can see the return was 1.38. 13.69 in 2014, 32.39 in 2013, and we can scroll it back for the requisite number of years, and we end up at 1996, where there was a 22.96% rate of return. Now, I am going to take those numbers and put them into an actual chart. So here's what you have to keep in mind when I show you this Excel spreadsheet. First of all, I've taken the rates of return from slickcharts.com in terms of the S&P's actual rates of return from the years 1996 to the year 2015, 20 years. And I want you to keep in mind this average of 9.85%. And one other thing, if we go on to MoneyChimp, let us say that you start with a $100,000 investment, and let's say we invest that over a 20-year period of time, and we have an interest rate of 9.85%, then we would expect to end up with $654,000 at the end of that period of time. But do we? Well, let me show you my spreadsheet. Now, I am not an expert at Excel, so I apologize if this probably looks somewhat clumsy, but here's what I've done is I have on the left, you see the year. Right next to that, I put in the S&P's return taken from the slick chart information. I've assumed a starting balance, you can see it in yellow, of $100,000. Now you can see that the percentage is rounded, but the market rate of return is simply a rounded and in percentage form of the column B, which says S&P return. So 22.96 rounds to 23%, 33.36 rounds to 33, 28.58 rounds to 29, and so on down the chart. What I have attempted to do here is to actually say, on the assumption that you start off with $100,000 in 1996, you get a 22.96 rate of return. You would end up with $122,000 and change. You keep it invested. I'm assuming you're not touching the money. Every year, we simply return the rate of return, the actual rate of return that the S&P returned. And what we find is that two things happen. The first is that the average rate of return between 1996 and 2015, the average rate of return by my calculation is 9.9345, which is slightly higher than the 9.85, but it doesn't matter because that still rounds to 10%, as you see. So the average rate of return is 10%. But remember, we just looked at the Money Chimp calculator. The Money Chimp calculator told us that we should expect to have $654,000 at a 9.85% average rate of return. And here, the average is actually 9.93. It's a higher rate of return. Now, I have actually run the calculation on 9.9345, and you can see that if we had actually obtained that every single year, we would have ended up with, let me highlight it here in red, we would have ended up with $664,783.31 if the $100,000 actually were operating like compound interest. But it isn't. It simply isn't. If you actually run the numbers starting at $100,000, the actual market experience that you would have left you with $482,000, which I'm not saying is a reason to complain. You started with $100,000 and after 20 years you are at $482,000. But what I'm simply saying is, number one, when you think about this difference, there is a difference. There is a meaningful difference, and the difference can be represented in mathematical terms by what's called the compound annual growth rate. So when you calculate, as we see here, and I'll highlight it in yellow, you can see here the average rate of return is 9.93. All you do to calculate that average rate of return is you add up the return the first year, the return the second year, the third year, all the way down to year 20, and you divide it by 20. It's just a general way you calculate an average. If you add up all the returns and divide by the number of years, you get the average, and that's where the 9.93, or in the case of the article we just consulted, the 9.85, that's where that comes from. But you see that that average rate of return does not function like a compound rate of return. If it functioned like a compound rate of return, we would have $664,000, but we don't. We only have $482,000. So the differentiating factor is something called the compound annual growth rate. And there's a formula for calculating that. But when you actually run the compound annual growth rate formula, what you find is that the performance in the market basically functions as if the compound rate of return were 8.19% instead of 9.93. And if we run the compound interest calculator on 100,000 at 8.19, you see we end up with $482,342, just as we did. And I'll mark it again in orange so you can see it. These two numbers, both in orange, are exactly the same. The one I obtained on the left, I obtained by applying the actual S&P return year after year over 20 years. And the one on the far right, I obtained essentially by plugging 8.19 into a compound interest calculator. But here's the question for you. If you're told that you averaged 9.85%, why does your money perform as though you only got 8.19? Here it is again with Money Chimp. So if we use the figure that was in the article from the balance, where they insisted that for the 20-year period ending in 2015, the S&P averaged 9.85, we go over to Money Chimp and we get $654,000. Now, I said I got 9.93.
So if I plug 9.93 in, you see you end up with 664,000, and that's the number that I actually got. I'm not saying I'm right, it's just my calculation of the average probably is different from theirs. They might be using more precise numbers. I'm assuming Slick Charts is correct. It's not important because 9.85 and 9.93 both round to 10%. And the point is at 10% over 20 years, you would have 600 and something thousand dollars, and we don't have that in the account. What do we have? Well, remember I said we started with $100,000 and we had over 20 years, according to our compound annual growth rate calculation, an average return of around a compound return that comports to a compound interest of about 8.19% annually, and that's exactly right. 482,000 is what we ended up with, which means that the 10% average, or the 9.85% that the balance tells us was the annual average for the S&P, should have generated us 654,000, but we actually got 482, right? That's a difference of $172,000, roughly 654,000 to 482, or in the case of my calculation with a slightly higher number, that's a difference of $182,000. Where did the $182,000 go? And the answer is that when you're dealing with an average rate of return, you cannot use a compound interest calculator to give you an accurate representation of what you're going to end up with. Now, there's a couple of corollaries to that. The first is I'm going to go to a presentation that was given on Dalbar. Dalbar is the financial community's leading independent expert for evaluating, auditing, and rating business practices, customer performance, product quality, and service. Now, Dalbar talks about different investor behaviors and how the average investor tends to do worse than the actual market. And one of the recommendations that they give is to set expectations. I'm looking at the middle of the page here, best practices to avoid money losing behavior, and they include things like control exposure to risk, monitor risk tolerance, present forecasts in terms of probabilities, but also set expectations below market indices, right? So if you think, well, the S&P is earning 9.85, it's earning 10%, so that's what I'm going to get. You are already, according to Dalbar, setting yourself up for a money-losing behavior. But beyond that, you have to realize that that average of 9.85, you cannot look at the effect that that is going to have on your portfolio by typing it into a compound interest calculator. You simply cannot do that, because you're going to get the wrong number. Now, the question is a little bit worse, or a little bit more pointed than this, because if you look at the very next sentence, and this is an article titled Why Average Investors Earn Below Average Market Returns, and if you look at 2 sentences later, you see the average equity fund investor earned a market return of only 5.19. Now, that's striking, because even though the market averaged 9.85, the average investor only averaged 5.19. And if that's an average, then guess what? Their actual rate of return, if you were to think about its equivalent compound rate, would be even less than that. And it's striking, because if you look, and here I'm looking at an article titled Why Are Individual Investors So Bad at Investing? And they are quoting, again, or drawing information from Dalbar. You can see the top of the graph, the 30 years investors in equity funds fall short of the market. The S&P over 30 years averaged 11.11%. The average investor averaged 3.9. 3.9 average. That means that their actual investment experience, if we were to run that compound annual growth rate calculation on it, would certainly be south of 3.69. And here again, you can see the similar article from Newsmax, which the kind of unflattering, provocative title, Study Investors Are Dumb, by Mr. Michael Kling. According to the Quantitative Analysis of Investor Behavior, the QAIB report from Dalbar, a financial research firm, equity fund investors earned an average return of 3.69% for the 30 years through 2013. The S&P, on the other hand, returned 11.11% during the same period. And notice this, the equity fund investors earned an average annual return of 3.69. So once again, their actual performance is going to be south of what you would expect. If you typed 3.69 into a compound interest calculator, you are going to get a number that is bigger than what these investors ended up with, almost for sure. And it is at least worth, I think, pointing out the difference, because it's important to have realistic expectations about where you're going to have your money, what kind of an effect market performance is going to have on your portfolio. This is a really basic point that average returns cannot be predicted accurately using a compound interest calculator.
So one more time, why is this an issue? I think it's an issue because many otherwise astute financial commentators routinely represent the average annual rate of return, even though they say the S&P is an average, and in many cases they'll even say you got to realize it moves up and down every year and you're not going to get this actual rate. Then they proceed to use a compound interest calculator to project your earnings. And I think this is a problem. Of course, as I made the point earlier in the video, they are absolutely correct that the market, when you have it invested in some vehicles, has a compounding effect on the money. There's no question about that. It has a compounding effect. And what I mean is, it's not just a simple rate of return. It's not like there's a simple interest rate operating on a principal over and over again every year. It is the entire bunch of money that you've got invested. It's your principal plus whatever earnings. And so there's a compounding effect. But that compounding effect should not be confused with a compound rate of return. The average rate of return in the market is not a compound rate of return. And if you use a compound rate calculator, you're going to get a number that is too big in almost every realistic scenario that you can envision in terms of the market. So I think this was a somewhat abstruse concept. I think it's an important one, however, when you're trying to get a handle on what your actual returns in the market might be. If you found something of use, of interest in the video, please like it, please subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I look forward to seeing you again in another video, and I thank you for persisting with me this far. Thank you.